What you need to do when an economic depression strikes. When the Federal Reserve
said that they were about to increase the interest rate.
Why do you think that most investors and people in business began to worry? And what does that have to do with economic depression? Well, stick with me until the end of this video to find out more. Hey guys, I'm Munif, a self-made multimillionaire with multiple brick and mortar businesses that have closed billions in sales. I'm here to teach you what it takes to become successful through my real life experiences. So if you like this type of content, go ahead and hit that like and subscribe button. Now, I know there's plenty of gurus out there, but I can guarantee you I'm not after anything but giving you solid advice. Now, as of September 21st, 2022, the federal fund rate is 3% to 3.25%. This is significantly higher than its interest rate last March, which was only about 0.25% to 0.5%. For those who are not familiar with this federal fund rate or interest rate, it is the interest rate used by banks when they borrow or lend money to each other. Consequently, it also affects the mortgage rates and personal loans and credit cards and investment prices, or anything involving money, to be accurate. So if the interest rate is low, it's easier to take out loans. So the number of people who want to borrow naturally also increases. As a result, consumer spending also increases, accelerating economic growth. On the other hand, borrowing costs will also increase when interest rates are high, causing consumers to borrow less or not at all. This will decrease consumer spending and it will slow down economic growth. And that is what the Federal Reserve is trying to achieve. Slow down economic growth to achieve economic stability. This is because the alarming increase in the inflation rate, which is currently 8.3% as of August 2022, much higher than the long-term average that we had been experiencing, about 3.25%. The Federal Reserve is also hoping to lower the inflation rate by slowing down that economic growth. That is why investors and people in business are starting to worry, because by slowing down economic growth, the possibility of experiencing a great economic depression also increases. So what happens when there is a great economic depression? It's going to cause a lot of other depression too. But first thing that happens is unemployment rates start to spike. According to the United States Bureau of Labor Statistics, the unemployment rate last August was 3.7%, which is about 2% higher than they had predicted. And the number of unemployed rises from 334 to a staggering 6 million. Second, the consumer goods demand will decrease and possibly even collapse. And third, as a response to the decrease in demand, businesses will also try to cut down production. Fourth, investment activities will also slow down. Just like what is happening right now with S&P 500 index, it's lost more than 20% in the last 9 months of 2022. Despite these numbers, Sam Zell, the real estate mogul, still believes we are not yet in the Great Recession. But these are definite signs of an economic decline. And investors are also warned about those tough times coming ahead. Now that we're done with all of that, let's talk about how these increasing interest rates and economic decline will likely affect your investment and your money. First is the stock market. While the U.S. has experienced numerous economic declines in its history, a Great Depression is pretty rare. However, due to the economic slowdown, increasing interest rates, and decreasing consumer spending, prices are rising, and companies themselves have difficulty sustaining profits for years to come. This backs up what Sam Zell said in one of his interviews, that businesses would have some tough times ahead, and experts call these times earning recession. During a company's earning recessions, the stock market will also experience a decline, and currently, stocks have dropped more than 20%. Second is the housing market. According to the National Association of Realtors, home sales were down by nearly 0.40% from July and 19% from the previous year. This is all due to the increasing mortgage rates due to Federal Reserve's increasing of interest rates. This leads to decrease in demand and fewer buyers, less competition for homes. As a consequence, the sellers might need to settle for a lesser price than anticipated. And third, let's look at the bond market, also known as the debt market. For those who don't know what bonds are, they are debt securities issued by the government to fund the payment of their debt or to fund government infrastructure projects. Now, they are also being issued by some publicly traded companies such as Microsoft, Apple, and Amazon, usually to fund business expansions or company acquisitions or stock repurchases. So basically, they are lending money and being paid back with a certain interest. For instance, if you buy a 2-year bond from the US government, you will be guaranteed a rate of return of about 4.15%. This is what makes them generally less risky than stocks and real estate. And for the effect of interest rates on the bond market, they have an inverse relationship. So when interest rates are high, bond yields will be lower. And during a recession, when the interest rate and inflation tends to be low, bonds perform well. They are like a safety net for investors when the economy is not doing well, because they are less volatile than stocks. And lastly, cash. Sam Zell also emphasized that being liquid in times of economic decline is very important. This means you need to set aside some good old cashola if something happens. But remember that cash is sensitive to inflation. Very sensitive to inflation. And at times like this, when the inflation rate reaches as much as 8.3%, the value of money decreases significantly. On the other hand, if you don't set aside some cash, you risk putting yourself in a very dangerous situation in case your investments fail or if you lose your job. So even with the risk of losing its value due to inflation, I think it's still imperative that you have some cash set aside. Ideally, 3 to 6 months of your monthly income is good. And when I mean cash, I don't mean cash under the mattress, I mean liquid assets. So suppose you're earning around $5,000 a month. In that case, it's ideal to have at least $15,000 to $30,000 of cash set aside for emergencies and add more for any potential investment opportunities that might come up during this time, and have some extra uncommitted cash for a peace of mind. Before you continue, I want to know your thoughts about what's going on in today's economy, no matter where you are in the world. Are you in the recession camp or not? Please let me know why and why not by leaving some comments down below. We're now going to talk about how interest rates affect different markets. Let's go on to what we can do to prepare for any recession or depression. If it doesn't happen, then great. But what if it does? At least we've prepared to face it head on. When you invest, usually the goal is to beat the market and rake in huge returns as much as possible, right? But the thing is, only a handful do this. And according to Todd R. Tresidder, the founder of FinancialMentor.com, as long as regular investors try to beat the market, they usually underperform. So instead of trying to outperform the market, the regular investor should focus more on losing less to get better returns. So what you can do is, first, avoid the mistake that the average investor makes. Most investors are predispositioned to sell at the worst possible time and buy after the market has already begun to rise, mainly due to the fear of missing out. And in doing so, they essentially sell at the bottom and buy at the high side, decreasing overall gains. When the stock market is doing great, it is very easy to get carried away. So keep your enthusiasm in check. And remember, there are always ups and downs in every cycle, and the stock market is no exception. So when things are bad, be optimistic, because you can then buy stocks at reasonable valuations and expect higher returns in the future. Second, you need discipline and a plan. Regardless of what your investment purpose is, it's always good to stick to a plan. It's always good to have a plan and then stick to it no matter what happens. For instance, if you are passively investing in the S&P 500 index fund and have been doing so consistently over the past years with a fixed amount and or on a daily basis, don't just change your strategy midway and stop because the market is currently experiencing a slump. As I mentioned, every cycle has its ups and downs, and buy and hold on your investments until everything goes back to whatever normalcy we're coming from, and then you end up earning more over time. Third, diversify and balance your portfolio. When the economy experiences a decline, the interest rates tend to go up, making bond investments a favorable investment as they offer greater returns during this time. One of the things I wanted to point out is there's a lot of companies that are way overvalued, especially in tech. And back in 2008 and 9, I learned the hard way because I was fully immersed in tech with a lot of my investments. And what ended up happening is there was a lot of cleaning up. A lot of companies were overvalued, not based on the money that was coming into the company in terms of profit, but on future plans of what they could be making. And that really hurt a lot of tech stocks. So diversify your portfolio and don't stick all your eggs in that one basket. This is just because we're more stable and less risky, and that's why bonds are the way they are, and less volatile than stocks. So they perform well during an economic slowdown. Maintaining a balanced portfolio of bonds is said to have a 60% positive return even when the stock market is down. But remember that this is not always a guarantee. Like any other investment, bonds also have a risk. They're just lower risk than stocks. Lastly, buying in the dip. This is an investment strategy in which you buy low and sell high. You're not worried about the fear of missing out. When a stock prices has fallen and it's a solid company, there's an opportunity to buy stocks at a lower price. But don't just buy any stocks with a cheap price. Buy those that have a clear sign of going up again in the future. Now that we're done with the stock market, we're going to talk about opportunities in my beloved real estate. Even though mortgage rates are continuously increasing, it seems, there is still a positive look in real estate, particularly in commercial real estate and multifamily, which is my bread and butter. This is because most people buy properties based on money availability and not on overall market conditions. So if you have a property that you've been eyeing, saving money is more practical than taking out a loan. Considering the high mortgage rate right now, since it may not be practical to take out a loan right now, there's also fewer buyers in this particular marketplace. Fewer buyers, more property. This means less competition and less demand, with more inventory, more to choose from. This will all just be a matter of time before real estate costs decrease. So keep an eye wide open for opportunities. During this time is when I tend to buy most of my property. This brings us now to cash. You can't take advantage of this time without setting aside some cash and being liquid. And to quote Sam Zell again, it also comes down to liquidity to determine who will come out as a winner or loser. If you don't want to miss out on buying an appreciating asset at lower prices and without taking out a loan sometimes, it is better to start saving money right now as much as possible, especially now that it is predicted that commercial real estate and multifamily will start to see price improvements later this year. 2022 and the coming years will be tough for investors, for the economy, for companies, for workers. But don't be disheartened. As they say, for every crisis, there is always an opportunity. So continue your investment strategies, continue to save up money as usual, stick to your plan. Don't miss out on buying good deals when you see them, either in real estate or in the stock market. Investing is a long-term game and you have to be committed to the end result. You'll end up losing some money, but as Robert Arnold said, investing what is comfortable is rarely profitable. So now that things have become so uncomfortable in the marketplace, the opportunity to earn more also presents itself if you can see it through to the end. Thank you so much for watching, guys. If you like this kind of content, please go ahead and hit that subscribe button and give this video a big thumbs up. There's a lot of information that you were presented and my team does a bang up job in getting you the best information possible. If you want to learn more about opportunities in the housing market, go ahead and watch this video, Why the Housing Market Continues to Rise Next.